China is significantly impacting the U.S. economy by slashing imports of American agriculture, technology, and energy. This has led to a record agricultural trade deficit, with soybean exports plummeting, semiconductor sales shrinking, and a record agricultural trade deficit looming. The backdrop to these developments is the trade war that began during Donald Trump's first term as president in 2018. Following a report by Special Trade Representative Robert Lighthizer that identified unfair Chinese trade practices, the U.S. imposed tariffs on $370 billion worth of Chinese goods. These tariffs were phased in over a year and a half, with the highest rate set at 25% and an average rate of approximately 20%. China's response was swift and targeted Beijing, imposing retaliatory tariffs on over $100 billion worth of U.S. products, specifically targeting key agricultural exports such as soybeans, beef, pork, wheat, corn, and sorghum. The impact of these measures on U.S. agricultural exports has been significant and measurable. In 2016, the U.S. accounted for 40% of China's soybean imports by 2024, which had plummeted to just 18% by 2024. This dramatic shift represents a major blow to U.S. soybean farmers who have long relied on the Chinese market as a key source of demand. As China reduced its imports from the U.S., it turned increasingly to other suppliers, most notably Brazil. Brazil has increased its share of China's soybean market and replaced the U.S. as China's top corn supplier. The overall decline in U.S. agricultural exports to China is stark, with China's agricultural imports from the U.S. standing at $43 billion by 2022. Further declines are expected in the coming years as China continues to diversify its import sources and increase domestic production. Despite setbacks, efforts were made to improve trade relations between the two countries. In January 2020, Trump and China signed a Phase 1 trade agreement, which committed China to increasing its purchases of American goods by $2 billion over 2 years, including $32 billion in agricultural products. However, these commitments were not fully met in 2021, as China launched commercial trial planting for genetically modified corn and soybeans. In February 2022, U.S. trade officials reported that China had failed to meet its commitments under the deal, with China's purchases of U.S. farm goods falling short by approximately $13 billion. In 2022, China took a significant step in diversifying its agricultural imports by allowing wheat and barley imports from all regions of Russia. This move signaled China's willingness to look beyond traditional suppliers like the U.S. to meet its agricultural needs. On March 7, 2022, Chinese President Xi Jinping emphasized the importance of self-reliance and food security, stating that if China couldn't hold its own rice bowls, it would be controlled by others. On June 28, 2022, China passed a soil conservation law aimed at protecting crop yields in key agricultural provinces, particularly in the breadbasket provinces of Heilongjiang, Jilin, Liaoning, and Inner Mongolia. On April 14, 2023, China unveiled a plan to reduce soy meal ratios in animal feed to less than 133% by 2025, specifically designed to curb soybean imports. On May 4, 2023, China approved a variety of gene-edited soybeans, marking China's first approval of gene editing technology to boost crop yields. On December 26, 2023, China issued licenses to a first batch of 26 seed companies to produce and sell genetically modified corn and soybean seeds in certain provinces. In April 2024, China approved the safety of gene-edited wheat, followed by allowing imports of 2 varieties of genetically modified corn grown in Argentina. On June 3, 2024, China's first food security law aimed at achieving absolute self-sufficiency in staple grains and food production. Finally, on October 25, 2024, China launched an action plan to accelerate smart farming and precision agriculture to raise food output. These measures have collectively put China in a stronger position to withstand potential U.S. tariffs and raise the possibility of further Chinese retaliation targeting U.S. agricultural interests. The impact of the COVID-19 pandemic on U.S. farmers and the U.S. economy is significant, with studies predicting annual losses of $3.6 to $5.9 billion in soybean production value and $0.9 to $1.4 billion in corn losses. Soybean prices have dropped by 60 cents to $1 per bushel, while corn prices fell by 8 cents to 13 cents per bushel below baseline levels. Major agricultural equipment manufacturers have reported decreased demand for tractors and combines, while rural transportation companies face reduced shipping volumes. The U.S. Department of Agriculture projects a record $42.5 billion agricultural trade deficit in 2025, a dramatic reversal from America's traditional position as a global agricultural leader. China's Made in China 2025 initiative aims to reduce the country's dependence on foreign technology imports and position it as a high-tech superpower. As part of this effort, China has significantly increased its research and development expenditure, reaching 2.4% of its GDP in 2023. This narrows the gap with the U.S. in the crucial semiconductor industry, which has seen a rise in global semiconductor production from 3% in 2015 to 15% in 2024. U.S. export restrictions on advanced chip technologies designed to curb China's progress have had mixed effects, slowing China's access to cutting-edge technologies and incentivizing Beijing to double down on domestic innovation. Experts say that China will double investment and support for its domestic chip industry to remain competitive. U.S. firms are lobbying for federal support, with the CHIPS Act signed into law in 2022 allocated $3 billion to boost domestic semiconductor manufacturing. The U.S. energy sector has been significantly affected by China's import reduction strategy in 2021, with exports of liquefied natural gas to China declining by 25%. Meanwhile, the West has sanctioned fuel imports from Moscow due to its invasion of Ukraine. China's crude oil imports from Russia rose 55% in May last month, equivalent to roughly 1.98 million barrels per day. This is up a quarter from 1.59 million barrels per day in April. China's imports of Russian liquefied natural gas amounted to nearly 400,000 tons last month, 56% more than the same month last year. Despite Western sanctions, Russia remains the top ranking of suppliers to China. After a gap of 19 months, China is the world's biggest crude oil importer despite lower overall crude oil demands due to COVID-19 curbs and a slowing economy. China's overall crude oil imports rose nearly 12% in May from a year earlier, as Beijing has refused to condemn Moscow's war and leading importers have stepped up buying cheaper Russian oil on top of sanctioned supplies from Iran and Venezuela. China imported 260,000 tons of Iranian crude oil last month despite U.S. sanctions on Iran. After the Russia-Ukraine conflict, China deepened its energy ties with Russia, signing a 30-year agreement for natural gas imports via the Siberia pipeline. Additionally, China has secured long-term LNG deals with Qatar, including a $60 billion agreement signed in early 2024. The decline in Chinese demand represents a significant loss for U.S. energy companies, as the EIA reported a 22% drop in LNG export. Trump's promise to punish China to bring jobs and prosperity back to the U.S. has been met with mixed reactions. Manufacturing employment has been declining for decades, and cheaper Chinese products have boosted the U.S. retail sector and fueled more U.S. consumption. The geopolitical uncertainty over Taiwan and the rise of the Global South have led to increased costs for consumers and retaliatory moves from Beijing. Tariffs are ultimately paid for by the consumer, and the evidence shows that there are no employment gains from sectors receiving tariff protection. For example, many of the produce that Americans purchase comes from Mexico, which increases construction costs and affects the U.S. auto industry. Retaliation from China is expected to be detrimental to consumers, as many autos cross borders multiple times before being sold to consumers. The U.S. government has been reportedly considering imposing tariffs on Mexico, Canada, and China to protect domestic manufacturers and encourage American companies to create jobs at home. This comes after Trump announced his intention to impose new tariffs on these countries on his first day in office before the November 5 election. Best Buy CEO Corey Barry warned that personal electronics could become more expensive if Trump carries out his threat to slap new tariffs. Barry said that any added costs on U.S. imports from the three countries will be shared by customers, as there is very little in the consumer electronics space that is not imported. The Consumer Technology Association has warned that Trump's proposed tariffs could lead to higher prices for smartphones, laptops, tablets, connected devices, video game consoles, and computer accessories. Ed Bitwa, the CTA's Vice President of International Trade, said that some trade group members are front-loading 2025 imports into 2024 to get out ahead of the tariffs. In the geopolitical sphere, the Russian ruble is currently collapsing due to Putin's economy being in trouble, with over 1 million young men dying, weakening interest rates, high food prices, and high unemployment. Recent reports indicate that the Russian ruble has hit its lowest point against the US dollar since Putin's Ukraine invasion began, falling to 107% dollar on Tuesday. This fall follows the U.S. Treasury Department's announcement on November 21 of sanctions on dozens of Russian banks, which have been widely used for international payments. Another headline story concerns Chinese media about the Blue Sky boom, a new social media company that rivals Elon Musk's X. The growing popularity of Blue Sky, which has a largely liberal base and harder to manipulate algorithm, has sparked worried chatter within Chinese state media circles. A former Xinhua and China Daily employee predicted that accounts will migrate to Blue Sky, though it may take time for now. Russia and China are trying to reach in and change the algorithm, with Vladimir Putin knowing that he would never win a war against America but can trick the American people. This is what he did successfully over the past decade but not over the past 2 years for the U.S. The U.S. is facing a critical energy crisis, with the U.S. sanctions on Russia's Gazprom bank intensifying it. The sanctions have been effective in some cases, but others have been less effective. The European Union is facing a critical energy crisis intensified by U.S. sanctions on Gazprom bank, the primary channel for Russian gas payments. As winter approaches, this decision risks halting gas supplies to heavily reliant nations like Hungary, Slovakia, and Austria, affecting Europe's already fragile energy market. Gas prices are surging, reserves are depleting faster than ever, and colder than usual weather forecasts add a chilling urgency to the crisis. The U.S. Treasury Department imposed sanctions on Gazprom Bank on November 21, 2024, the primary financial institution handling European payments for Russian gas. This move to disrupt gas supplies and destabilize an already fragile energy market is threatening the European energy sector. Joe Biden has been trying to ramp up the pressure on Russia by imposing sanctions on Gazprom Bank, which is the primary financial institution handling European payments for Russian gas. The U.S. has been able to get tens of thousands of likes on Blue Sky, a platform where facts and rationality prevail. However, disinformation is so clearly rewarded on X that facts will get thousands of likes and everyone can fact-check these actors who are trying to mess with America. Elon Musk gives these malicious actors the biggest platform they've ever had now. The economic impacts of Trump's proposed tariffs include raising prices for fresh fruit and vegetables, hurting farmers when other countries retaliate tariffs, and distorting the marketplace and raising prices along the supply chain. The U.S. is the largest importer of goods in the world, with Mexico, China, and Canada as its top 3 suppliers. People looking to buy a new vehicle likely would see big price increases as well at a time when costs have gone so much they are out of reach for many. A 25% tariff on Mexico and Canada would severely the U.S. auto industry, as automakers could not quickly change where they build vehicles and raise prices for already costly automobile repairs. The Distilled Spirits Council of the U.S. said tariffs on tequila or Canadian whiskey won't boost American jobs because they are distinctive products that can only be made in their country of origin. In conclusion, the U.S. is facing a complex and potentially dangerous situation due to its sanctions on Russia's Gazprom bank and the ongoing conflict between Russia and the EU. The U.S. is taking steps to counter these threats and ensure that the EU remains resilient in the face of these challenges.